Okay, so let's start today's lecture. But before that, right, I just want to quickly show you the Canvas site or tutorial site. So just a quick note that for today's lecture, lecture 2, I did an update in the morning. I mean your morning, Thursday morning. So in case you downloaded it last week, I encourage you to download the new slides. But nevertheless, if you want to use the old slide, don't worry. I'll point out the changes. There are some minor changes here and there, and the changes on the last example that we're covering. Okay. Also, some of you ask what is this additional practice question. So you see here there are quite a few practice questions here. So if you do attempt them, you can simply drop me an email and then I can share the answers with you. But as you know, school policy is that we cannot post the answers. So, you can just email me directly once you have done it. Just send me your workings and then I can just have a look at it and then advise you accordingly. So these are the questions. So from financial analysis practice question all the way down. So you'll see all the practice question. So financial statement analysis, this is lecture 1, practice question, additional practice. And then free cash flow, you can do it from this lecture onwards. All right. And for this, there is this thing called lecture example. If we have time today, I would like to go through this. But if not, you can have a look at it later on your own time. This is basically an example with solutions provided. And I think it will be useful, especially when you use FactSet to support your answers, because this question kind of go into the nitty-gritty details on things like selecting which rates and which numbers to pick, right? So for this lecture example, if we do not have time to go through this, I encourage you to look through the question without seeing the answer or reviewing the answer first before you look at answers, because this would really test your understanding of the components for WACC, right? And as usual, if you notice at the end of each lecture notes, you will notice that there's self-practice example component. So that is usually with the answers provided. So that one you can practice as well. Any questions regarding questions to practice? How should we prepare? Okay. Guess everyone's good. Okay. All right, perfect. Then, okay, let's start lecture 2. So, as usual, what we'll do today, we have 2 breaks. So one for each hour. That's okay for you all. I think it's better at least we have a small break to go to a toilet or even get a cup of tea. At the same time, so for today, a broad overview of what we're covering, right? Before we dive into the details. So last week we covered the qualitative aspect of doing valuation, right? So we talk about Porter, SWOT, we talk about various economic analyses, etc., financial statement analysis. So all the qualitative components. So this lecture we'll cover now the quantitative component, and lecture 2 is a overview of 4 quantitative methods that we'll learn, right? So it's just an overview, and in subsequent lecture 3, 4, 5, and 6, we'll dive into the details of each of the 4 methods, and we'll include a 5th method as well, 5th and 6th method. So lecture 2 basically is just an overview, and it's a good time, to really ask any questions regarding the 4 methods, because once we go into lecture 3, 4, 5, it is really in-depth. We'll look at various scenarios that we need to consider when using the 4 methods that we cover in lecture 2. So lecture 2, it's an overview, but at the same time, it's quite important that if you do have any questions, if you have some doubts, feel free to clarify them, right? And of course, we'll go into the details of things like what's discount rate, which discount rate should you use, etc. So all the details that is kind of important for your quantitative valuation, but at the same time, is not the in-depth calculations for each method that we are going to learn. Okay. All right, so let's kickstart this. So let's go right back to the basic, right? So what's a discount rate? So I think this is not new to everybody. Everyone knows what's a discount rate, and why do we even do discounted cash flow? So basically, the idea of doing a valuation is that by being able to estimate the cash flow, right, we are able to determine the value of a instrument, and this is done through discounting, future benefits to the present day, right? So future benefits in the sense of what we're interested is in cash flow, and when we do such discounting, we need a discount factor. Of course, we need a number of periods that we're going to hold security or the equity. Okay. So as usual, these are just some theory, nothing to memorize. As you know, at the end of the day, the focus is on valuation. So all these kind of small things is just for understanding, right? So let's look at discount rate now. So in discount rate, there are two key rates that we need to consider: cost of equity and cost of capital, right? So there are two different types of rate. So cost of equity is when we do equity valuation. Now, this is very important. And cost of capital is when we want to value a firm, right? So do not confuse the two rates, because you need to be very clear. If you are taking a standpoint of a shareholder, which means your equity holder, that means you want to use the cost of equity, right? If you are taking the stand of the firm meaning considering both equity and debt, then you need to use the cost of capital. All right, and the classic cost of capital is WACC, right? Cost of equity usually is RE, because it's called RE, it's the short. All right, so the discount rate can be nominal or real. So if you want to do real, as you want to consider inflation in your valuation, remember you need to use the Fisher equation. So in this module, we'll not cover the Fisher equation, but there's this thing called Fisher equation. So where you do real discounting, you need to consider Fisher equation to derive the real discount rate, and then use that real discount rate for your valuation. But in this course, we are just focusing on nominal. So we'll focus on nominal discount rate. So we talked about this. So when we want to do this, we want to use the cost of equity. Basically, we are interested. Who is interested in this is the equity investor, right? But if we are using cost of capital, that means it's all claim holders, which basically means the equity investor and the debt. So there are a few things to consider as well in terms of your cash flow. So in terms of estimating what's your future cash flow and which part of the life of the equity or the business will the business achieve stable growth, right? And so why is this important? Because we need to determine this thing called the terminal value of the equity, right? So what is the terminal or terminal value of this equity? Because it can persist. I mean, as you know, most stocks are traded on the market indefinitely, right? So we need to determine what's the terminal value, right? So at the end of the day, we choose what is the best discounted cash flow model, and this today we are covering 4 of them, right? So a bit more details about the equity and firm, equity versus firm. So as I mentioned, this is important. So do not confuse which rate to use, whether is it WACC or use the RE, right? And we'll look in details how to calculate them. And I believe for most of you all that is a kind of a refresher, as we covered in other modules. Currency as well. Of course, we need to consider currency. For this, it's more about making sure that you use a consistent currency for your valuation of the particular firm. So if you're using USD, make sure you use USD for everything, right? Nominal versus real, we have talked about this. All right, so let's talk about the four methods first before we do this part on a dividend discount model. So the four methods that we're going to cover today is the dividend discount, which is what you see here, valuation with dividend. All right, and I believe this is not new. Then we'll look at the free cash flow to firm. So FCFF, free cash flow to firm. So let me just write here what the four models. DBM, free cash flow to equity, right? And we'll look at RI, which is called residual income, right? So four models. Now let's just kickstart with the first model. So the first model we are focusing on is on the dividends of the firm. And so, of course, if we are going to value the firm using dividends, the firm has to be paying dividends, right? So we are looking at mostly, publicly traded firm which announce their dividend, quarterly, not really quarterly, but semi-annually, and so that we can use the dividend amount, discount it to find the value of the firm. What's important to take note is also they have to establish a consistent kind of dividend policy. Maybe there are a few methods we look at how they achieve or how they set their dividend policy, but it has to be consistent, right? Because there are a lot of assumptions where we do valuation, especially on the terminal value component, which is the part where we need kind of consistency in order to value it. Because if the policy keep changing, like 1 year is 10%, 1 year is 20%, next year is 5%, then it's very hard to do the valuation, especially in terminal value component. And last but not least, investor takes a non-controlling minority interest. Why is this important? Because if you are a minority interest, a non-controlling minority interest shareholder, basically what you're interested in is just getting dividends, right? We are not interested in owning the company, because of course maybe you only have 5% or even 1% of the company, right? So your interest is mostly on the dividends that you receive. Of course, there could be capital appreciation as well, but mostly it's about dividends, right? So that's why if you are that kind of investor where you have a non-controlling minority interest, maybe the dividend method, dividend discount method is important, or should be the appropriate method for you. Last but not least, it's often applied to mature company. Generally, because for mature companies, their dividend policy is quite established. Established meaning that they pay very fixed amount of dividends per year, or fixed percentage of dividends per year. Okay, so before we carry on, I just want to highlight to you why are all these factors important. So remember, at the end of the day, right, when we do valuation, you are given with or what we cover in this course is to give you tools, right? As we talked about last lecture, when we talk about various qualitative kind of tools. So in this lecture, it's the same. So we have four options here. So the thing is, as a equity analyst or as someone trying to value a firm, you need to be able to decide which method to use. So should I use this? Should I use this? Should I use this? Should I use this? So we give you kind of like the characteristics of what is important to consider before choosing the valuation method. Of course, at the end of the day, most valuers use a combination of a few approaches. For example, maybe I use this, use another color, I use this, and then I compare my valuation, and then I do an average, or maybe I choose one other over the other because of various reasons. Right? So all these factors are important, and it helps you substantiate when you write your valuation report why you choose this valuation method. Right? Any questions at this point of time? Okay, nothing so far. Okay, very good. Guess it's clear. Okay, very good. Then we talked about some dividends policy methods. Basically, all common shareholder will get dividends unless you are preferred shareholder. Or a preferred shareholder do not really get dividends. They get a preference in terms of distribution if the company goes into liquidation. So there is no difference. Important thing to take note is that this is a bit of a technical point. Dividends, there is dividends paid, dividends declared. So any dividends that is not declared will not be paid. So there are two steps, right? Dividends must be declared first, then it's been paid. So if it's not declared, means that there is no payment to the shareholder. So that's a technical point. Of course, a company usually pay out dividends with whatever cash they have left after paying paying creditors, paying various things like buying new equipment, capex, opex, etc. Right? So they cannot, or usually they do not pay dividends more than what they have left in terms of their earnings, right? So usually not more than 100%. So earlier I mentioned there are a few methods for paying dividends. It can be a fixed payout ratio here, right? So it's fixed, constant dollar. So it can be, say, every time I'll pay $2 per share. So it's constant $2 per share every time. It's constant dollar. Residual means that if there is any cash, then I'll pay out, and then I'll pay out all the leftover cash, the residual cash that I have, right? So that's a residual dividend kind of method. Okay, so for each of the four methods, or actually, yeah, for each of the four methods, you will notice that there's this slide with this like a line chart or bar chart. Not really a chart, but line, right? So this is like a summary slide that I have done. If you go and compare with the other tutorial groups, you'll not see this. But basically, it goes through the steps that you need to take when considering using this valuation method. So this, you'll see later, 2 more or 3 more of this line and various information. So if you choose that method, make sure you go through all the steps, right? From 0, 1, 2, 3 to 4 to n. Right, so let me try to explain to you what's this and how do you use this summary to consider or to calculate the valuation using this method, and in this case, dividend discount. Okay, so let's start off with the left side. So we want to value, when we value dividends, right, we are actually valuing the equity, right? Because remember, we talk about dividends being, you have to be usually it's valued if you are a non-controlling minority shareholder, and if you are a shareholder, means you are a equity holder, right? And so what we're interested in, we are valuing the equity of the firm, right? Okay, so we are valuing the equity. That's number one, we need to take note of. Now, dividends. In order to use the dividend discount model, we need to be able to calculate what's the dividend amount, right? So the most basic form of how to calculate dividends discount model, or dividends amount, sorry, is that if they give you what's the dividend payout ratio, and this dividend payout ratio is usually in a percentage, like let's say 20%, right? So if it's 20%, then you just simply take 20% times your net income. So you know that every time the company will pay off 20% of your net income, right? So that's the amount of dividends that is being paid. So that's pretty easy. But I want to remind you that there is also the retained earnings formula. Anyone remember this retained earnings formula from your accounting 101? This formula here. Is this something that you have seen before? Oh no. Oh no, your accounting lecturer will be unhappy. So, okay, maybe some yes, some no. Okay, but let me explain to you why, how this formula works, because it's important. And most of the time, when we value companies, right, we'll use this retained earnings formula. Because if we are trying to value a company using the financial statements, obviously, most of it will not publish what is the payout ratio, etc. Although we can actually derive the payout ratio. But what we can do is we use this retained earnings formula. Okay, very good. I think most people are, some people wrote it out. Perfect. So thanks for writing it. So ending retained earnings equals to beginning retained earnings, right? Ending retained earnings equals to beginning retained earnings plus net income minus dividend, right? So basically, if you have all the components here, we can derive what's the dividend paid out, right? So this, in accounting terms, is usually we call it the retained earnings formula, right? But in finance, right, there is another name. It's called the clean surplus relationship. So let me just write it for you. We're here. Oh, it's a terrible writing. So we'll hear this term over the course of this module. So it's clean surplus relationship, RS, right? So it's the same thing. So if someone say the clean surplus relationship is basically the retained earnings formula, right? So it's a bit more fancy in finance. We call it the clean surplus relationship. Basically, yeah, it relates the retained earnings of the firm, the ending retained earnings, the beginning retained earnings by considering the net income. Okay. And this relationship is usually used to derive or determine what is the dividends here. Okay, so we have covered this. We have covered this. Now let's move on along this line. So we need to consider what's the cost of equity. And because remember, we are taking the role of a non-controlling minority shareholder. So we need the type of discount rate we'll use is the cost of equity, right? So this is important. We are using cost of equity for this kind of method, for this valuation method. Now, there is an important component where we need to calculate what is the growth. All right. So we have a few slides on, or one slide on this, but if you recall, there's this thing called the G, right? Remember in last lecture, when we talk about things like growing perpetuity, growing annuity, there's always a G. So I hope you have done some of the self-practice question if you're not so familiar with the time value of money. But we did cover, growing perpetuity. I told you that that's quite important for valuation. And so how do we get this growth factor that we used in the last lecture and we talked about in the last lecture? So we need to calculate G. And one of the way to calculate G is that since we are taking the stand of valuing an equity and we are using the cost of equity, then we just take the retention ratio multiplied by the return on equity. Okay, so this part here would change based on what are you valuing. So in this case, we are valuing equity, we multiply by return on equity. Later, when we look at when we do the free cash flow from firm, you notice this will change. Okay, so this is something you take note of. It will change. But this part retention ratio stays the same. And we'll explain to you what retention ratio in a bit. Last but not least, we need to determine what's the terminal value. And when determining a terminal value, in almost all cases, we try to assume that the firm will grow at a stable rate, meaning that the firm is on a stable trajectory upwards. And so we generally use the growing perpetuity formula. So that's where your time value of money, your skills in time value of money is important. I will not explain to you again what is all this, how do you do it, but basically it's just growing perpetuity. All right. Any questions so far for this summary? All right. So all components of this slide is important because you need to make sure that you choose the right numbers. Okay. All right. So let's look at the growth factor now. G. So I believe this is a small recap from your finance or FIN 203, where we did talk a bit about the growth factor, but let's look at it. So to calculate what's G, and okay, so before that, this is utilized for the DDM and the FCFE, where both of it we are valuing the equity of the company, right? So to value the equity of company under these two methods, we calculate G by multiplying the retention ratio by the return on equity, ROE. And before we go into the details about how this formula works and all the components of this formula, the intuition or the idea behind it is that whatever money, all right, that is being retained in the firm would allow the firm to use this money for growth, right? So by determining what is the amount being retained, multiplied by what is required or what's the return that's required by the equity holders, we will be able to determine, oh, okay, so if that's the case, then the firm must grow in this trajectory or this percentage to reach that return amount that's required. So that's the idea of this formula, right? So G basically here is the growth rate without the need of any equity or debt. So basically whatever money that's retained in the firm. So that's the idea of this formula. And okay, so I want to remind you that before we go into the details below, that for ROE, most of the time, you have to calculate ROE on your own. So in the question, they do not give you what's ROE. And I want to remind you of the use of the DuPont formula, where sometimes they either give you just the financial statement, right? So how you calculate ROE, you need to take the returns or net income divided by your sales, right? So ROE. Now, net income divided by total equity, that's ROE. So you can either plug these figures given from the financial statement, that's one method. The second method is certain questions, they do not give you the financial statement at all, right? They just tell you, oh, I have this equity multiplier, I have this total asset turnover, and they give you net profit margin. So if you do not realize that this is part of the ROE DuPont formula, then you're like, oh no, I can't find the G, I can't calculate what's ROE, right? So that's why I want to remind you that there's this DuPont formula. And of course, there can be a lot of variations in terms of how or what components they give you here, right? And so you need to be able to manipulate the various formulas for the ratios to derive the ROE. Okay, so we have talked a bit about the ROE. Now let's look at the retention rate. So retention rate basically means 1 minus the dividend payout. So this is a bit intuitive, right? So whatever that is not paid out is being retained, right? So that's why 1 minus the dividend payout. And how do we determine what's the dividend payout? We take dividend divided by net income, or dividend per share divided by earnings per share. Now, if we want to calculate retention rate directly, if we are given the amount retained, we can take the amount retained divided by total net income, right? So why this slide exists? Because sometimes questions can be a bit tricky in a sense they give you certain components, right? They don't give you directly retention rate or ROE. They give you the small sub components, and then you have to derive retention rate and ROE. Okay. So much for the growth factor. Now, in terms of cost of capital basics, so now we'll look at the rate that we use, right? So the intuition behind this is, of course, the more risk you take, the more returns you get, right? You should be rewarded for taking on risk. So that's the basis of it, and that will determine what's the discount rate that we use. Okay. So for cost of equity, as you know, in a DDM we need to use the cost of equity. Is the rate that we have to return equity holders. Okay. It includes both business and financial risk. And we have three methods that we're going to learn how to use. These three methods are important. Why? Because as you know, at the end of the day, in this course, we're trying to value a firm. Sometimes, or actually most of the time, the discount rate is the very key factor that would change your valuation a lot. Because remember, we are using discount rate to discount all the cash flow. So 1% change in discount rate will actually alter your valuation decision, right? So in this case, determining how you come out with your discount rate is very important, and that makes the difference between a star analyst or maybe a not so good analyst, right? So there are three methods that we're going to learn here. Sometimes we just use one. Most of the time, analysts would say we use a combination of three, meaning it can be an average, or maybe you place a weighted average on one or two of the methods we use. Or sometimes how they justify it is that, oh, all three methods give us very similar cost of equity number, and therefore this substantiates the number that we choose, right? So that's why we learn three methods here. And all three methods are important to understand. So method one, bond yield and equity risk premium. So question to you, between bonds and equity, which is more risky? Yeah, I guess everyone knows that. Yeah, very good. Equity is more risky. Perfect. So if we have the bond yield of the company, and we know that equity is more risky, that means there must be a premium that is being placed on equity, right? So the first method is simply we have the bond yield, and we know what's equity premium, which is specific. This is specific to the firm, yeah, because this is specific to a firm because it's tagged to the equity, right? What's the premium and equity? So if we have the bond yield and we have the firm's equity premium, basically add them up together to give you your cost of equity. So that's the first method. Quite kind of simple to understand, but at the same time, as you know, like charts like this changes all the time, right? So the difference between your bond and your equity, the gap changes, and sometimes it's not so direct. We just take one point in time, right? So you need to do like I don't know, equity premium over 10 years. What's the equity premium of the firm over 10 years? So you get the average and then you add it to the bond yield. Okay. Method two would be something that is quite familiar because we are using a CAPM. So I believe everyone heard of what is CAPM, where we are using the idea of a beta. So what is beta? This is a small recap. So beta is basically the systematic risk of the firm. And so remember, risks are divided into two components. Again, the recap. So there's systematic and unsystematic risk. So unsystematic risks are the risks that can be diversified away by holding a portfolio, right? So these risks will be all gone if you have a portfolio. Now, whatever that remains in the portfolio is the beta risk or the systematic risk. And systematic risk is measured in this thing called beta, and basically it measures the volatility of that particular stock relative to the market. All right, so in the market, the beta is 1, and any stock that is above 1, right? If beta is above 1, means it's more volatile than market. If the beta is less than 1, means that is less volatile than market. So that's all about beta, right? So it's not some number that you plug from a Bloomberg terminal, right? So the understanding is that simply measuring the volatility of the stock relative to the market. Right? So what we have here, more than 1, riskier, less than 1, not risky. Important ones are beta of the market is 1, and a T-bill, meaning a risk-free kind of instrument. Of course, there is no systematic risk, so beta is 0. Now, why is this important? So for a star analyst, if you want to call it, when we use method 2, the CAPM model, CAPM, one of the key components of the CAPM model is the beta, right? So rather than plugging the beta from Bloomberg, FedSet, which is being calculated for you, a star analyst, what they do is that they will actually find out or do a regression, right? So they regress the stock return against the market return. So this is market return on the x-axis and stock return on the y-axis, and they do a regression on various stocks. Sorry, not various stocks, various returns of that particular stocks against the market return, and then they calculate what is the gradient here, and this gradient is your beta, right? So in your valuation report, if you believe that the beta in FedSet or Bloomberg or Refinitiv or whatever platform that you are harnessing your data from, if you believe that maybe that beta might not be correct, or if you want to validate their beta, I would suggest that you do a regression. Okay, you do this method. So you regress the stock return over market return. And of course, you present your answer. This would be excellent. There will be a great method to calculating the beta. Anyone have questions regarding how we calculate beta here? So remember, at the end of the day, I'm giving you all these tools. So when you do your valuation report, you choose what you think is required, and of course, you substantiate. If you say, oh, you know what, I'm not going to do a regression on the regression of the stock against the market to calculate beta, yeah, fine. You say you want to just rely on FedSet beta, that's fine. But you need to, of course, substantiate. Like you say, oh, we have compared the FedSet beta with, let's say, the one in Capital IQ or Bloomberg, and it seems like all the betas are very similar. Yeah, then you have a good point to substantiate. Okay. All right. So once we calculate what's the beta, now we can calculate what's the risk premium. Again, risk premium is what is above the risk-free rate, right? So what's the rate of your equity minus your risk-free rate? So that's your risk premium. Higher beta generally should have higher risk premium. And the relationship that exists between risk premium and beta basically is your CAPM, your CAPM model. All right. And now this is a bit more technical, but I like to usually go through this because it helps you understand how the CAPM model even appeared in the first place, right? So let's recap. What is the equation of a line? Anyone remembers? Remember this from your secondary school? Equation of the line. What's the formula for that? Yeah, okay, very good. I see that most of your, or all of your remember y equals mx plus c, right? Perfect. So now we plot a graph or line using the two axes. First, asset return and your asset beta, right? So we are talking about one stock now, just one stock. Okay, we know there are two key betas that I mentioned earlier. Market beta is 1, risk-free beta is 0, right? So we can plot our two lines. We know that risk-free is 0, which is here. Perfect, we have this. We plot what is the market beta 1, which is this point here, right? Now, having 2 points of a line, we can calculate the gradient, right? Yes, perfect. You can calculate the gradient. How do you calculate the gradient? Take ERM minus RF, right? Divided by 1 minus 0. Everyone can see this? How do you calculate gradient? Which equals to ERM minus risk-free. All right, so we have the gradient. Now, can we write the equation of this line here? We can, right? We can write the equation of line. So let me just use another color. So what is y? So y is ERI M. So I've calculated what's M. M is here. ERM minus RF. What's X? Let me just put this. Times beta. X is beta, right? BI. Plus, what is C? The intersection, which is RF. Yeah. So can you see this? Sorry, it's a bit messy, but can you see this gives you this thing here? So I've just written the CAPM formula. So there you go. It is the CAPM formula, which is here. This is a nice way to write CAPM formula. All right. So having understand this, then you know a few things here, a few characteristics of the CAPM formula. Is first of all that the slope of the CAPM, which is considered a security market line, is the risk and reward ratio. Why risk and reward? Risk being the systematic risk, which is the beta, which is the X, right? And Y being the return, right? So that's the rewards that you get. So risk and rewards. The slope is basically a risk and rewards part. And all securities that are in equilibrium would fall on the line. What does this mean? This is a very important concept to understand. It means that if your security is in equilibrium, all of them will have the same gradient, right? Can you see it? Same gradient because they all fall on the same line, right? So it means that in terms of the beta, all security beta should tend towards 1.0, the market beta, right? So in a scenario where you have a beta of, let's say 1.5, which is actually very big, 1.5 is very big. This would likely be a startup firm, something that's very new. And as it goes, as it progresses, the firm develops, the beta should tend towards 1.0. And we call it the mean reversion of the beta that's happening in the market. All right. And this has been empirically proven. And so that's why all securities will eventually fall on the security market line that we have just seen, where the beta would tend towards 1. Okay. And if you understand this, then you will be able to derive this formula. Something to just take note. I think hopefully it does not confuse you now. Is this thing called market return and market risk premium. So there are two different things. If it's a market risk premium, is this formula, and if market returns means that you do need to take the market returns, which is here, minus the risk-free rate. Generally, for market returns, we use the S&P 500 if we are using or we are trying to value a US fund, right? So S&P 500. Now, I don't want to go into too much detail about this because in the lecture example, if we have time, we'll go through that. If we don't have time, we can review it. But you see that risk-free rate with, I will say, is T-bill, T-bond, market risk premium is S&P 500, etc. So remember now, why this cost, is considered more of like an advanced cost, is because in most cases, you no longer is given the value of what is risk-free. Most questions will ask you value a firm, right? They don't say risk-free treat or assume risk-free rate as 5% or assume risk-free rate as 3%. There's no such thing. So a lot of the times you need to come up with justification of why you choose a risk-free rate. Should you choose a risk-free on S&P 500 if you are valuing a Singapore firm? No, right? You cannot use that. Maybe you use a Straits Times Index. So you need to be able to substantiate choosing the various components, like all these things here, right? Like choosing the components to fit into your formula. So a lot of substantiation and justification is required in this, in valuing or valuation in general. Because questions are no longer about say assume this, assume that, and of course you cannot say I want to assume this. Even if you want to assume a rate, you need to justify why you're assuming this rate. All right. So much about method 2. Now the last method is going back to your growing perpetuity. So hopefully you have done the recap if you're not too familiar during the last lecture. But if we rearrange the growing perpetuity formula, we can actually pass out the RE that's here, right? So if we are given the D1, remember it's D1, which is dividend next year, right? If we are given D1, and we have the price of the stock, and we are able to calculate G, remember how to calculate G just earlier, the retention rate times ROE. So if you are able to do that, then we can actually pass out the RE here using this formula. I'll highlight these, call this. Okay, we have a question here. So if you are valuing a firm for 5 to 10 years, and we have be careful on the risk rate. Yes, that is a very good question. So in this lecture example, I would like to, hopefully we have time to do this, but if we don't, I highly encourage you to look at it, because this lecture example is going to answer all these questions, and it's going to tackle a lot of small little details that you're like, I have to consider this, because it's going to question you in terms of every aspect or every component of the valuation that you need to consider. And in this case, I think you mentioned you want to value a firm for 5 to 10 years, right? So to answer your question, generally, what you have to do is you need to choose a risk-free rate or the maturity or duration of their risk-free rate, for example, T-bill, to match the project's duration, right? So if you're doing a 10-year project, or you want to value a firm for 10 years, meaning that you are, let's say you're going to, your purpose is holding the stock only for 10 years after you're going to sell, right? So if you're going for 10 years, then you should choose a risk-free rate based on the 10 years horizon, right? So you should not choose a 20 years rate. Thanks for that question. But about your risk-free, right? Later when you have the time, or if you have the time to go through, you will see that there are some caveats in using the risk-free rate, which I'll talk about, which is mentioned in this example here. Okay, so this part here. Okay, if you have the time, please review this. This is very important. Okay. Yes, that's a good question. Now you will have to do a weighted average. You are right. You have to weight the wait let me see. You're asking different revenues, so weighted average of risk-free rate. Yes, correct. So you will have to do a weighted average for the risk-free rate, because it's coming from different countries. That's correct. And you also have to, if you look at the lecture example here, there's this thing that we talk about just here. So this is important. There's this component on sovereign rate, the local currency sovereign rate. Meaning, what's this? It means that, if different countries have different premiums, right? For example, Singapore is very stable. Maybe the default risk is very low compared to, let's say, somewhere in Africa, let's say Gabon, right? Sub-Saharan Africa. The country risk premium is very high, right? So because of this difference, we need to consider also various country risk premium in our equity analysis. So this is slightly beyond the cost. And of course, if you can do it, it will be amazing. And that's why I still want to put it here. But because in real life, if you will eventually become an equity analyst, you have to consider all these things. And we really go to this person's Damodaran. He's like really famous in finance. Maybe some of you already know about him. He wrote like many textbooks and all, but he's very famous for his this page where he provides you the market risk premium, okay, for all the countries, and he updates it like very regular, every month or something. You can copy the link and have a look at it. So if you consider this in your valuation report, that would be amazing. All right. Okay, so now that's all for dividend discount. So remember, dividend discount model, we are considering it from a non-controlling equity shareholder perspective. Now we're going to the two key methods that we tend to use more often, which is the free cash flow to firm, which is FCFF, or free cash flow to equity, which is FCFE. Okay, so again, what we start off with is how do we choose this method? Should we use the FCFF or FCFE? So there are a few things you need to consider here. Now, if we use the FCFF, what we're doing here, we're taking a view from a perspective of both the bondholder and shareholder. What does this mean? It means we are using the WACC. We are not using the cost of equity, right? So we are taking the perspective of both the capital contributor, in this case, equity and debt. So what does this mean? It means that the cash flow to provide for additional investment can be distributed to the capital providers. So you want, first remember we're doing valuation, right? So this, if you use the FCFF, is the valuation to capital contributors, meaning the debt holders and the equity holders. Okay. Now, if we want to use the FCFE, now this one is only we are focusing on equity holders here. Okay, equity holders means what we are using the RE return on equity, and what does this mean? We are only interested to see or to understand what is the investment that we can do for equity holders. And what does it mean? It means that we need to include any debt service obligations into, we need to remove the cost of providing additional debt payment, right? We need to remove that. Then we can consider the FCFE. Okay? You will see this more clearly when we look at the formula, that this debt service obligation has to be removed away. Okay, so before we go into the details of valuing the firm in the FCFF, let's take a quick break. Things about time. We can come back at around 8:03, 8:04, right? We take a quick 7 minutes break. As usual, any questions, feel free to write it in the chat. We can answer them after the break. All right, welcome back. Hope you have a good short break. So I see no questions so far about the DBM. That's good. Let's push on to understand more about the FCFF now. So FCFF, we are talking again about the firm. So now it's slightly different. We are using the discount rate of WACC, which is the average cost of capital. And as you know, this consists of your debt plus equity, right? And equity, we need to consider both the common shareholder and the preferred shareholder. And we look at the WACC. We do a short recap of WACC in a bit. And that's how we calculate the value of the firm. Okay. So like the DDM, we have this very important summary slide that I like to use. And it's kind of a reminder of all the components that you need to use in your valuation using the FCFF, as well as the components you need to justify, right? The numbers that you justify. First, since we are trying to understand what is the value of the firm, right? The firm, there is this easy, not easy, but like a simple kind of formula where it says the value of equity is simply the value of the firm minus the value of the debt, right? So if you want to find the value, if you are given the value of the firm and you are given the value of the debt, you can find what's the value of equity, right? It makes sense because the firm is made out of equity and debt, right? So if you have one or the other, you can actually pass out the missing component. Now, what do we need to find out? Cash flow. Okay, so what is the cash flow? In terms of cash flow, this is the most common formula that we use, but later we'll see there are a lot of derivation. They are simply the same key formula, just that we break them out, right? Like EBIT. EBIT can be broken down or can be, we can use the less simplified version, we can use the EBITDA, or we can use the more bottom line item, we can use the net income. So this is the, I would say, standard formula, but there are many derivations of it, right? This determines the cash flow. Once we are able to determine the cash flow, we again need to determine what's the discount rate, and in this case, we're using a WACC. And a few things to consider. WACC, you need to consider the weight, right? Based on market value that's being placed here. So later in the slides, you'll see a lot of details in terms of each of these components, but remember, this is just a summary. We need to consider cost of debt, and we have I believe 3 methods to calculate cost of debt. We already have we have discussed how to calculate cost of equity, so we're not going to go through that, but have to determine cost of equity as well. Okay. Now, for the growth factor, remember, we always have to determine the terminal value, and terminal value is usually determined by the growth factor. In this case, what is key to take note is that we need to use the return on capital. Recall for DDM, we are using the ROE, return on equity, right? Because now we are valuing the firm, we need to use the return on capital instead. So that's different. Return on capital, return on equity is different. Because remember, capital is debt plus equity, and without equity is just equity. All right. Again, in this simple form, we are treating a stable terminal value here, right? So we are using the growing perpetuity here. So I want to put a big caveat that in the next few lectures, the standard approach here will differ. Differ how? Because we will talk about firms that might grow fast, then grow slow, and then go normal. So there are like changes here and there, right? So that's where we go into detail. But now what we're talking about is more of the standard approach. So it's just this stable growth, stable growth forever. Okay, so let's tackle the first component first, determine the cash flows. So this is the cash flow formula, CF. Remember, earlier I mentioned the most standard formula is the this one, the EBIT one, the red one here. right? This is the most standard formula. I want to highlight to you that if you are reading the study guide, there are actually quite a lot of mistakes in study guide. So look at the error sheet that's posted on the main lecture site, as well as just be very careful when you read because there are a lot of errors. So hopefully it doesn't confuse you. But rest assured, if you just review the notes, it should be good enough for your assessment. But if you want to read more, it's good to read the study guide, but just be careful. Okay? Because once I noticed, especially from lecture 2 onwards of study, unit 2 onwards, there are quite a lot of mistakes. Okay, so there are 3 components to your FCFF. There's the operating cash flow, the net capital spend, and change in net working capital. All right, so we'll tackle each component. So this is a very important slide. So first of all, operating cash flow. So operating cash flow, we basically is just what's the cash flow from the firm's daily operation, right? And if what do you notice here? You notice that we have to always add back depreciation. Why? Because depreciation is a non-cash item. So what does this mean? So in your income statement, right, you have like a sales, you have expenses, and then you get your gross profit, and then you have some other expenses, and then you have your net profit. Okay, this is a very simple example. Now, in your expenses, usually there's this thing called depreciation. Now, depreciation, there's no cash going up. Perfect, you're right. It's just an accounting item, and therefore it does not really reduce the cash that you have, right? So you have to always add back depreciation when calculating your operating cash flow. Right? I repeat that you have always to add back your depreciation. And then you notice these 3 formulas, they look kind of similar, but basically you are using different derivation, right? So this is net income, this is EBIT, this is EBIT, but then you use the tax rate instead. Last but not least, this is the tax shield method of calculating operating cash flow. Why is it called a tax shield? It's because your depreciation, your depreciation and as well as your interest reduces the amount of tax that you pay. Because remember, tax is only the tax is applied to the whatever residual income that you have or taxable income that you have after determining removing your depreciation and your interest, right? And because of that, what happens? If you have more depreciation or more interest in your expenses, you reduce the taxable income, right? And therefore, you are taxed less. That's why it's called the tax shield, right? Shield as H-I-L, right? Tax shield. Okay, so 4 formulas. You need to determine which one you want to use. Okay, so going on to the next component, net capital spend. There are it's basically quite intuitive in the sense is what is the amount spent on capex or capital expenditure. What's important to take note is that if you are given net ending net fixed asset and beginning net fixed asset, anyone know what's the difference between net fixed asset and gross fixed asset? So this is a bit going back to accounting again. So what's the difference between net fixed asset? Yes, correct. Net is after depreciation. Perfect. Yeah. So if you are given net fixed asset, then you have to add back your depreciation. Right? Understand? If you are given gross, then you don't have to care about depreciation here. So please read very carefully or in your financial statement. Net is after depreciation. Depreciation. Yeah, no, it's not depression. Yeah, so just take note, not depression, but depreciation. So yeah, so take note gross and net. And this is important because most of the time when you do a valuation of the firm, you are looking at the like financial statement, right? Like annual report. There are a lot of details. So please read very carefully. Most of the time, what is presented in the annual report is the net. That's why I put this here, right? Like this. Most of the time it's the net value. But the thing is, I want to highlight that later we have an example, a lecture example, at the last few slides, that because it's an example, they tell you, oh, it's a gross. So you need to consider gross, really, right? But if when you're doing valuation, most of the time you use annual report, it's always a net. But it's important to know what's net. So net, when it's net, you use what? It's gross is what. Okay, last but not least, change in net working capital. So what is working capital? Hope you remember that working capital is CA minus CL, current asset minus current liabilities. But when we are calculating the FCFF, it is the change in net working capital. Change meaning what? Ending minus beginning. So you need to calculate the change, not the net working capital. So so you take the ending minus the beginning. Of course, if the change in net working capital is positive, means the firm is growing, it's spending, meaning you need more working capital. So at this point of time, right, I usually like to highlight something. A lot of people is like, oh, you understand what is a net working capital, CA minus CL. But I want to bring in the intuition behind what does it really mean. So everyone know what is a capital expenditure, right? Capital expenditure means you use to buy property, equipment, office computers, etc. So that's capital related. For net working capital or working capital in general, is basically how you think about it is that if anyone asks you what's working capital, is simply the capital that's required for daily operations of business. So all the business, they need fixed asset, so that is your capital expenditure, and they also need working capital in order to operate the business on a daily basis. And so that's what we're calculating here, CA minus CL, which is your net working capital. So of course, with this intuition in mind, you kind of understand, right? If a firm is growing very fast, means that you need more capital for daily operations, right? So a positive change means that capital is expanding, usually the business is usually, Any questions regarding this formula? So three components. In this lecture, you will see one example, but we are not going to like really the details. In lecture 4, where we will go into all the nitty-gritty and the various scenarios of FCFF, will you really need to use this formula, and like you need to select each component from the financial statement. So this is very important to understand where all the small components come from. Okay, all right. So this just to highlight to you again, the growth rate for FCFF is the return on capital, so not return on equity. It's important. Now, let's move on to the next component. Remember, we are supposed to use WACC, right, to discount. We have covered part of WACC, which is cost of equity, right? We have 3 methods. Now, let's talk about cost of debt so that we can put them together to calculate WACC. So there are 3 methods again. We compute yield to maturity on existing debt, yield to maturity on new debt plus credit risk, and then last but not least, bond rating. So we'll go in detail, not to worry. Important thing to take note is that the cost of debt is not coupon rate. Anyone know what's a coupon rate, or do you remember what's a coupon rate? So this is going back to your fixed income, your bonds. So what's the difference between yield to maturity? So cost of debt is yield to maturity. So what's the difference, yield to maturity and coupon rate? Okay, okay. Yes, I can see kind of correct. Yeah, coupon rate is like the bond interest. Yes. Yeah, that investor get. And then the yield to maturity is the actual interest rate, right, of the bond for the full life of the bond. The actual rate, return, perfect. Yeah, actual return. Coupon rate is more of just the interest that you get per usually semi-annual, right? Yes. Yes, correct. So I see most people understand the difference here, which is good. That means you recall what's your fixed income, what you have learned in your fixed income modules. So what's important for cost of debt, we are interested in the yield to maturity. So you always want to calculate yield to maturity. Also, important thing to take note is that interest is tax deductible. So when we get a cost of debt of this, if you have a tax of this, you can actually calculate what's your tax deduction, right? There is some tax shield, again, there's a tax shield by using debt, right? So actually debt is better than, if we just look at this information here, debt is kind of better than equity, right? But of course, then you have your default risk that come into play, etc., that kind of balances. That's why you need a balance of equity and debt. Now, this is a very simple example, but there's something I would like to highlight to you here that kind of is a very common mistake that happens. So the first method is existing debt. So for example, you are given this, and again, when I say given, is that you don't actually see this in your annual report. And remember, the questions are not like, oh, you have they tell you the current bond is 15 years, coupon rate is on. I mean, this is like probably your basic cost, right? So now what you have to gather from the that set, let me just quickly show you this. So usually you have to gather the information yourself. So again, I highlight the importance of looking at this. So for example, can you see this? This is what you can gather from FactSet. Coupon rate, date of issuer, maturity, price. Yeah, so what you can gather here, and then you can calculate what is the, sorry, this is market value of that, but you can calculate, sorry, let's go down. You can calculate what is the cost of that, right? So in any case, that is more of like a real life example, but if you are ever given something like this, 15 years, coupon rate of this, coupon paid semi-annual, this is very important, and the bond price of this, right? So once you know it's semi-annual, the important thing to take note is that what? Your number of years you must times 2, remember? So this is going back to your time value of money. Your coupon rate you must divide by 2, right? Times 1,000. And then at the end of it, your rate you must multiply by 2. This is very important. Most people forget about this. Okay? In order to calculate what is your yield to maturity, YTM. Yes. So if you go into FactSet, Bloomberg, if they don't tell you what is the par value, remember what's the par value? Par value, it is assumed to be 1,000. It's always assumed to be 1,000 par value, right? So that's your par value is basically your F. Yeah. But what I'd like to highlight here is this semi-annual component here, because most debt or most bond actually pay semi-annual. They don't pay annual. So you always need to consider this divide by 2, times 2, divide by 2, and times 2. These components are very important to consider. Okay. So this is on existing debt. So debt that has already been present in the company. All right, which is what you saw just now in the FactSet screenshot that you have seen. Now, the method 2 is that, okay, this is new debt. So the company has no debt yet, right? So if the company has no debt, it's going to issue new debt. What do we do now? We look at the rating of the firm. So we have a rating of the firm, okay? And by having the rating of the firm, can we actually add on various risk component, right? So for example, default spread, maybe you have a bit of like credit risk premium, So you add on some stuff, and which depends on, like let's say the maturity of the debt, credit rating, etc. So you have the rating of the firm, and based on the rating of the firm, you can determine what is the cost of debt, COD or COD. And after you just add in various risk components into it to give you your new cost of debt. Okay, so method one is based on existing debt, use time value of money, calculate period to maturity. Method two is using the rating of the firm, because you have no debt, rating of the firm, and you add on various risk components into it. I'd like to highlight here that usually credit spread is quoted on this thing called basis point. So some of you are already working, I believe. So if you're working, you know that we always use this thing called BP if you're working in the finance industry, basis point, right? So 100 basis point refers to 1%. Now, method three is actually the most common method used in the industry, is rating the bonds that is being issued. So, debt, we're talking about fixed income. Usually, in most cases, by rating a bond, it's easy for the company to market the bond. If the bond is unrated, investors do not know, right? Because remember, the bond rating and the rating of the company can be different. So the company can be like very low rating, maybe rated as a C, right? But the bond can actually be A or B. Remember, if you recall the 2008 financial crisis, what happens is that the underlying of your mortgage-backed securities are terrible, right? They are like junk bonds. But what happened? Because they securitize the instruments, they underwrite it, they add insurance into it, which is how they get a very good, highly rated mortgage-backed security. Right. So in the same sense, the bonds can be rated very differently from the firm. And so most investors would like to invest in bonds when they are being rated, so they know that the instrument itself, because of course, as an investor or as a debt holder, right, you're only interested in the debt. We're not interested about company at all. We don't really care about the company, right? But that's different. If you are equity, then you care about the company. If you're a debt holder, you just care about the instrument, the debt instrument. And so we only care about the bonds. And so what's the market usually prefer is just you just rate the bonds. I buy whatever bond. If it's rated good, I just buy it because I'm a debt holder. At the end of the day, in a liquidation, I get the first stake, right, of whatever money that's left. So I'm not interested in the company at all. And so in method three, we're rating the bonds here. And so, of course, if the bond is rated A, then the cost of debt is lower, right? A meaning that it's very highly rated, it's very good bond, and so it's not so risky. Because a low rating bond means that it's most likely to default, and therefore, the yield to maturity is higher. Okay, any questions? So those are the three methods for cost of debt. Last component is your preferred stocks. So preferred stocks usually pay out constant dividend, expected to pay forever, and therefore we usually use this perpetuity, a perpetuity to calculate what is the return or the cost of preferred stocks. So, in your valuation, nowadays preferred stocks are quite uncommon, right? So not so common nowadays. So when you're valuing a company, just look at the stock composition. Most of the time is usually like common stock, like class A, class B, class C, different kind of classes. But very seldom there's preferred stock. But if you do encounter some preferred stock, have a look at it, and then if you need to calculate the cost of the preferred stock, you can use the perpetuity formula. All right, I will not go through this. This is just 2.5 divided by 36, right? Perpetuity formula. Okay, so once you know what is your preferred stock, what's your cost of equity, cost of that, then you can use the WACC formula, which is a weighted average of the three components that we talk about, which is given here. All right. Now, we have talked quite a bit about this. We have not talked about this, nor have we not talked about weight. So remember, we are doing valuation now. So everything, every small detail that you use in your formula, you have to justify. Now, corporate tax rate, because this is a valuation, you're doing a valuation. If you look at the lecture example here, we will explain quite a detail about what corporate tax rate to use. It's not simply just take a corporate tax rate, average corporate tax rate, and just plug it in. All right. So please have a look at the example because it's not simply just take whatever corporate tax rate. Now, for the weight, in the next slide, we'll talk about the weight. So in terms of weight, we always want to use target weight. So not even market value. What's the target weight? What is the target composition, capital composition of the company? Capital composition meaning what is the target amount of equity? What's the target amount of debt? So that's the one that we want to use, target weight. Of course, that is usually not possible in most cases unless it's being published. Sometimes they publish it in the annual report, what's the target composition, but most of the time they don't. So we use the market value, right? Market value is, I would say 90% of the time you can find it if it's listed stock. So if it's listed stock, listed, you always can find market value, right? So you should always use market value. But if it's not available, and this is purely if it's a private company, right? That means there is no market information, then you use the financial statement values, right? What is the book value of debt, or what is the book value of the equity, right? But this is only for private company. So please do not use the financial statement numbers if you know that it's a public company, yeah? Because immediately if you do that, your valuation is wrong already. Like, even if you calculate your WACC, everything very well, unfortunately, it's not correct, okay? So I'll not go through this because we have the example here. And as you know, in this module, you'll not be tested or calculate WACC because this is a valuation module. Usually, this is already, it's given that you know this, and then you just need to like get the information from the annual reports, etc. Okay. Now I just want to let me see which questions should I go through. I think this one is fine. You can go through it. Okay, let me just go through this exercise. This is a little tougher, but it's still not so tough. And again, I want to repeat that you will not be asked this kind of question to calculate like this. This is just to illustrate, right? Okay, so you have the equity information, debt information. What's important I want to highlight here is they give you number of shares. So this is not the market value of the share, this is the number of shares. So you need to multiply it by the $80 per share. All right, this one we can use cap M, so no problem. I think it should be fine. Now let's look at the debt information. Usually debt is a bit more complicated. So whenever you want to do the cost of debt, try to maybe have like, even your GBA groups, try to have like 1 or 2% to look at it, right? Not 1, but 2% to look at it, because some debt is a bit tricky. What do you have to look? Okay, so you have the face value here, which is the par value. We have the current value. Okay, so this current value is your market value. So meaning this current value is the value that you want to use in your weights, right? Your weight of the components, not your par value. Everyone understand that? So in terms of the weight, remember you are using your current value, not your par value, nor yeah. And then it's a semi-annual. So make sure you do the appropriate times 2, divide by 2, on the various components. Tax rate is this. I believe there is the answer here. But any questions regarding what I just mentioned, the various components? Okay. Good. All good? Okay, very good. Okay, so much about FCFF. Now let's go. We have done that already, so I guess no question for FCFF. Now let's go to FCFE. And again, we would like to do the summary first, and this is a good reference slide for your valuation in the future. Same thing, we look at various components. Okay, we have, first of all, now we're going to calculate valuation towards the equity, right? So we have the cash flow to equity. We want to calculate what's the FCFE. So this is the this is kind of like this most of the very common formula that we use, right? So I'll explain it in a bit, but this is the one that we use where DR equals debt ratio. Okay. And you notice that you see in the FCFE, now what do we have to do? We have to consider the debt component. We have to basically remove the debt component from the free cash flow, right? Because now we only want to consider equities. So the equity holder. So we need to remove it. Previously, you notice we didn't really care too much about the debt component in our cash flows. Okay, what else? We are using the cost of equity here. So it's your RE, the usual method. There were three methods that we learned. The growth is the same. So G is the same as your DDM. And again, we are assuming a stable growth in the future. And this is just for this basic formula, right? Later, we'll look at all the fancier stuff where it's not a stable growth. So now I hope you like the third time we do this is a bit easier. Yeah, you can see like it's kind of like standard, right? The standard things that we consider, right? Okay, so what do we have here? Cash flow to equity. We have the cost of equity, KE or RE, depends on the variation. And what's important is that the DDM is actually a specialized case of your equity valuation based on your FCF. So they are actually derived from the same concept. So dividend discount model is kind of actually just the FCF model. Now let's look at the formulation here. Oh no, I forgot. So this is the part that there was a bit of changes. So I forgot to change this. This should be plus net borrowings. Can you edit this in your slides? I'm sorry about this because I've edited this, but I forgot to edit that. So it's plus net borrowings. Okay, so this is wrong. This is wrong. Okay, so your FCFE, which is your equity, is your FCFF plus any net borrowings that you get, right? So the question is, what is net borrowings? Net borrowings is basically any additional borrowings minus any loan repayments here. Okay, and we can derive like even further where your additional borrowings is change in your short-term debt plus change in your note payables plus any change in the long-term debts, right? So that's your at the end of the day, what's your net borrowings that you have. Now, your FCFF, remember, if you flip back to a couple of slides ago, can be derived into this component if it is a net income, right? So remember, there are various decomposition of the FCFF. So this is just one example using the net income. You can actually use the EBIT or even use the EBIT or even the tax shield method. right? But the main thing is that you just need to add in your net borrowings here. So this is one way to calculate FCFE. Now, the next way, which is using the debt ratio. So this is usually more the standard approach. Most questions will use this debt ratio approach to calculate FCFE. But if you're looking at the financial statement, sometimes it might be easier to use method 1 here. This method 2, where you actually have the debt ratio, which is total debt divided by total asset, and then we just use a ratio of 1 minus that. Okay, so if you look at it, the formula is kind of like this, but instead of plus net borrowings, you just in the debt ratio, right, inside here. I'll not be showing the how you derive the formula because that's not important. Will never be tested on derivation of formula. I want to highlight to you one more thing is that this is the target debt ratio. So while you can use the financial statement debt ratio, I'm sorry. While you can use the financial statement debt ratio, at the end of the day, you should use target ratio. So you should be able to notice now the difference is that in finance, we rely a lot on financial statement, but at the same time, there are a lot of things that we need to consider and say, hey, you know what, we cannot use financial statement because at the end of the day, financial statement is historical, it's not current. But when we talk about finance, when we talk about valuation in particular, we want the most current information, right? Because value of a firm is a life value that changes daily, right? So in this sense, a lot of the things we want is like market value. If we should at least try to get market value, but if we really want to do a very good valuation, we should use targeted values. And in this case, we should use the target debt ratio here. Okay, so now we want to think about, since we have learned 2 equity methods, DDM and FCFE, which method should we use, right? If we are interested in as an equity holder or equity shareholder. So in this sense, it's a bit easy. If the firm pays dividend, then maybe you should use DDM. But there's one caveat here. If it pays dividend that's close to the FCFE, right? Meaning that whatever free cash flow, we pay as dividend, right? If that's the case, then you just use dividend discount. Now, if the dividend is higher or lower than the FCFE, meaning what? That there are some free cash flow, but the firm has a very specific dividend policy. Maybe it doesn't want to pay out the dividend, it prefers to retain it. And if there's a big variation, there's a rule of thumb of 75%, then it's better to use the FCFE, right? So this kind of help you determine a little. At the same time, for firms where FCFE is difficult to estimate, so use the dividend discount. And of course, if firms do not pay dividends, then you have to use the FCFE. This slide is a bit small, but hopefully you have your slides in front of you so you can see it. And now the question is FCFF or FCFE, right? What should we use? So it really depends because now we are comparing firm and equity, right? So what are you interested in? The first question is to ask yourself, what are you interested in? Are you interested in the firm? Are you interested in the equity? So that's the first thing you ask yourself. And then once you know that it's the firm or it's the equity, then we look at the differences. Remember, for FCFE, we have to add back net borrowings, right, into the cash flow. So let's look at FCFE first. If the firm have a stable leverage, right, the leverage doesn't change crazy, like super crazy, then we can use the FCFE because we are adding back the net borrowings, right? And the net borrowings doesn't keep on changing. So we can use the FCFE. But if the leverage change over time. So for example, we are talking about things like a startup firm or like a firm in a new industry, right? Where things keep on changing. Things in the form of leverage keep on changing. Then we shouldn't use the FCFE. We should use the FCFF, right? Because we want to know what's the cash flow to all the capital providers, not just the equity providers. So again, if you have partial information on leverage, then use FCFF. Of course, if you have a good understanding on the target capital structure, use the FCFE here. So if you want the third point, we have talked about it. For a firm with multiple divisions with different growth prospect, so there are multiple divisions, so you have to consider the whole firm in general. So you consider FCFF compared to, if you are just have a single division firm, then you use the FCFE. Okay. Does not pay free. So this is just this is what we talk about for the BDM comparison. Value one division. Okay. Okay, before we go to residual income, do we have any questions regarding this the choosing the three models? So now, just to recap, we have learned three models: DDM, FCFF, FCFE. Any questions so far? Good. So far, so clear. So far, everything's clear. Easier, real life. Let me just think. Okay, real life example. You will really have to look at the firm in question, right? So I would say, as an equity equity analyst, and valuing the firm, and you're not a shareholder. Okay, you're not a shareholder. You are just valuing a firm. Typically, you want to use the FCFF, right? Because you are valuing a firm, so you want the cash flow to all capital providers, right? Now, if the idea, it really depends on what valuation or what's the purpose of the valuation, right? If your purpose of the valuation now is that you are a private investor, you want to invest in the firm, you're going to put in money, right? And once you put in money, you become a shareholder. And because if you're a shareholder, what you're interested in, you're actually interested in more of the FCFE, not, right? Because you're more interested in equity component. So that's where you use the FCFE instead. So, typically I would say, which one? Point 3, right? Whether you are interested in valuing a firm or equity, actually this is the main reason to choose the valuation method. Yeah, so it's not really based on the firm. And then, of course, after you say, okay, you know what, I want to be a shareholder, then you can substantiate more, right? You can say, oh, you know what, actually the firm, so, okay, so you want to be a shareholder, right? So you want to use the FCFE already, right? Now, the thing is, oh, okay, you know what, so because of that, I look at the capital structure as well. Oh, it's kind of stable and yeah, it's kind of stable, right? The leverage. So this kind of substantiate your point, like, oh, you know what? The FCFE is the right way to go. And remember, this is more controlling interest. So if remember for non-controlling interest, you are more interested in the dividends part, right? Remember this, earlier we talked about it. So it really depends on your objective at the end of the day of the valuation. All right, most welcome. Okay, so let's just talk a little more about residual income first before we take a second break. So what is residual income? Again, I would like to usually give a broad overview of what it means first, right? So that you understand the intuition before you go into the details and all the calculations, etc., etc. So, you know what? Earlier, so far, we have been talking about cash flow and we have been using like net income, EBIT, and all these things, right? The problem is that it does not take into account implicit cost. What's implicit cost? Cost that is not placed on the balance sheet, or not, placed on the P&L, right? So things could be like opportunity cost that is not seen there, right? Maybe substitution cost. When you change things, you need to pay certain costs that is not reflected on your P&L. And so these kind of costs are implicit. And what does this residual income model does? Or what does residual income does? So residual income is an economic profit where you take the revenue minus all costs, explicit, which is whatever is in the P&L, and implicit costs. Okay. So whatever that is remaining is your income that is like a residue, right? So that's why residual income. Okay. So now we're changing our thinking a little. We're looking at economic profits, not accounting profits. Okay. Now, this formula looks a bit scary, but I'll again explain to you the intuition. So if you understand what I mentioned earlier, this will make a little more sense now. So residual income, what does it mean? It's the income that is left over. So if you have a net profit, so let's see, residual income today, year T, is your net profit, right? Minus your equity charge. So what's this equity charge? Why is it not minus expenses or minus expenses, right? Which is like your accounting profit. Why is it not like this? It's because we are looking at implicit and explicit costs. And this, especially the implicit component of the cost, is being captured in your cost of equity. So basically, it's being captured here, cost of equity. So cost of equity includes what implicit and explicit costs, which is why we take a balance sheet item, sorry, a P&L item, which is net income, minus the equity charge, which is the more economic component, right? So if we have your net income, you minus the explicit and implicit costs, which is captured in this cost of equity, whatever that is remaining is basically your residual income. Right? So that's the whole idea of residual income. Okay, so you have your net income for this year, 2013. You minus your equity charge. Let's not think about this T minus 1 first. Just minus whatever charge that you have. It gives you your residual income. Now, let's think about why is there this T minus 1? Again, we are talking about intuition here, right? To understand the formula, so you don't just memorize it. So why is there this T minus 1? So think about it. We have our net income for this year, 2013, 2023, right? Your charges is usually based on the previous year, right? Your charge is based on the expenses, whatever, in the previous year. Which is why we take T minus 1. And so your cost of equity is the current year, and then your book value of equity. So of course, we use the book value of equity, and then we put in the cost, the implicit and explicit cost, which is like usually a percentage, right? And so this would give you your equity charge, and then we less off on the net income for the year. So whatever that's left is your residual income. All right, so we are looking at these three derivations first. I'll talk about this, the fourth one, in a bit. Okay, I see a question. Energy typically use FCFE regardless, since it's more equity investment purpose rather than firm. Yes, so you're right. So whenever we think about equity analysts, especially, equity analysis, usually the purpose of it is to invest in the firm, right? You are a private investor and all this. Usually we use FCFE, right? We don't use FCFF. That's right. That's right. FCFF is used for management, the firm, or debt holders. Yeah, that's true. All right. Okay, so going back to residual income, I hope everyone can see this. So basically, residual income is whatever that's left over after the implicit explicit cost, and we use the income from this year minus the equity charge from previous year. And how do we calculate equity charge? We just take the book value of equity last year, book value of equity last year, times the cost of equity, which is this year's cost of equity. Now, this is one formulation here that we have seen. The second formulation that is quite common is that we use ROE minus cost of equity times the book value of equity. So what does this mean? Can you see ROE is return on equity minus the cost of equity? Can you see the return on equity is basically what the equity holder will get, right? What's the return? Minus the cost. So what's left is your residual income. And then, of course, you multiply it by the book value of equity. And that's how you get the residual income. Right? So it's two different methods. Method one, where you look at the net income. And method two, where you look at the return on equity minus cost of equity. But it kind of looks similar. So just to highlight here, book value is the same as net asset or is equals to paid up capital plus retained earnings. Remember to add your paid up capital. So it's not only retained earnings. All right. So in terms of, so just now we're just talking about residual income. Now, in terms of the valuation using residual income, V naught, which is the value of the equity, right, equals to what? Remember, in this model, we are calculating residual income. That's just the income, right? So we need to add this income into an existing book value, right? Which is why we have this book value here. And this component is the residual income model, residual income that we calculated earlier, right? So we have a book value plus your summation of residual income. Summation is like residual income for year 1, year 2, year 3, year 4. You add it up together, gives you the value of the firm. All right. So there's two components, book value and then the present value of the residual income. Okay, so a question to you. What is the difference you notice in the residual income model for valuation compared to the 3 models that we learned previously in terms of this book value that we see here in the residual income model? What's the difference in this component compared to the 3 models that we learned, which is kind of like similar, but what is it different compared to this residual income in terms of this B or B naught that we see here? Anyone can see the difference? It's a tough concept about time. Not really. Okay, yeah, it's a bit a tough question, right? So the main difference you notice in the residual income model is where is the bulk of your valuation coming from? Let's look at residual income model. Where is the bulk of the value of the firm coming from? You notice is that the book value is the bulk of the value of the firm, right? Whatever that you add here, it is your residual, right? I mean, it's just this, I mean, this value is not going to be super big, right? The main bulk is book value, you add your residual in, right? Now, what happens in terms of your FCFF or the 3 models that we talked about? Remember, we have this thing called terminal value. Remember that I say, for this lecture, we are going about stable growth, about about just stable growth. We're not going to talk about all the intricate methods. And because of this, the bulk of this will be the bulk of the value, the terminal value. And what does this mean? You notice that in the last three methods that we learned about, the bulk comes from the future growth rate that we calculate. And therefore, the growth rate becomes super important, because if you expect a high growth, it's going to affect your terminal value and it's going to affect your eventual valuation. Now, in your residual income, is the opposite. We are looking at what is the historical book value, which is the one giving the bulk of your valuation and not your future value. Everyone understand this? This is a very important point. Anyone need me to repeat, or we are clear about this concept? Yeah, we are clear where the bulk of the value comes from. Yeah, that's perfect. Yeah, that's right. And because they are using slightly different valuation methods, if you're interested in valuing FCFE, which is to equity, if you compare residual income model and the FCFE, if the valuation that you derive from both methods are quite similar, means your valuation is very good. I mean, that means it gives a very consistent valuation, right? Because residual income is also to equity holders, right? So both methods are from different endpoints. One is FCFE, for example, is terminal value, same as DDM and FCFF, is all terminal values. The other one is book value. So if both, let's say the FEFE or DDM valuation kind of similar to your residual income, you can use it as a cross-check. Perfect. Yeah. So residual income, a lot of people like to use it as a cross-check method. However, I would like to point out here is that if you notice, both methods are actually from the same roots. I would say roots, like ground at a ground level is the same, but they branch out to different methods, right? So this slide, I mean, it's not important, but it's just trying to explain to you at the ground level, it's actually using the same discounting model here. See, you see book value, and then you discount all this, right? Using the same discount model here. And you'll notice, can you see this clean surplus relationship, which is simply what? The accounting retained earnings model. So it's the same thing, right? B is the book value of equity, which is basically the like the retained earnings count model that we have learned. All right, so this is just some comparison. They are derived from the theoretically same underlying theoretical models. Forecasts of various inputs are not done for the same degree of certainty, because one, we really need to estimate the G factor. Remember, one, we need to estimate the G. And then for residual income, we just need to use the book value, right? What else? So it's different because it starts with the balance sheet figure, talked about it. Use of residual income. Okay, so why do you use residual income here? So if you have a negative free cash flow, then the residual income might be useful, because if it's negative free cash flow, yeah, it's very hard to use your FCFE, right? Because imagine your negative free cash flow, then you're going to calculate, if you use you calculate a terminal value based on negative cash flow, your terminal value will get more and more negative, right? So your negative gets super big. So it doesn't make sense. Yeah, if you're valuing something that's negative, then you might as well don't invest. So because of that, you use the residual income model. Check for consistency. Yes, your friend did say that already. Perfect, that's right. You check for consistency. Again, this is a reminder, use the cost of equity, right, to discount your residual income. So this is a valuation summary that we have here, that the four models that we've done so far. Okay, before we go look at this example, let's take again like a, let's say 7 minutes break. We'll come back at 9:12. 9:12. Yeah. Okay. If you have any questions, feel free to put them in the chat. All right, welcome back. Um, we have a good break, short break. Okay, so I see a question regarding residual income. So, generally, I would say most of the time we use residual. Okay, so this is like the market practice, right? So we use residual income more for a check, for the FCFE, and because the thing about residual income is we include an implicit cost. And a lot of times when we do valuation, right? Yes, include implicit cost is theoretically correct, but in the market, it's very hard to determine this kind of implicit cost. And it's not so, people say, not so objective to include it, which is why a lot of people do fall back on the FCFE for calculation of the cash flows for equity. So yeah. Okay, so let's look at the example here. So this is the last example for this lecture. It's a very good example because it's simple in the sense they have take out all the information that's required for you. So it's all right. So you just pick the information as required. But then it's not so complex compared to looking at a financial statement. But at the same time, it requires you to pick all the information and they give you a lot of information here. All right. So you have your income statement, you have your balance sheet, and then they give you some information here. You have your 60% for the dividend policy. Um, there's a 5 million additional investment in this year. Working capital is supposed to increase. They tell you the cost of equity is this, which is given to you, which is quite good already, right? Number of shares is 1 million. And then you have all this, right? So you have to calculate the dividend per share, free cash flow for firm, free cash flow to equity, and residual income. So we are covering all the valuation methods that we have talked about. Okay. Except actually no, we are not doing the DDM. Yeah, we're not doing DDM. So if you have downloaded the old slides, then you'll notice that the workings are are slightly different, but at the end of the day, answers are the same. I just wanted to use the methods that I've taught you, or like the formulas that I've taught you, instead of the textbook formulas, which are slightly different here and there, but answers are the same. Okay, so if you have the old slides, you'll notice it's different, but at the end it's the same. So how do we calculate dividend per share? Two methods. We know that we can calculate EPS, earnings per share, which is taking the net income. Let me just flip over to show you. So you have net income here, and this is in thousands. All right. So we have the net income divided by number of shares, earnings per share, right? And you just simply take that multiplied by the dividend payout policy, 60%. So that's how you get the answer. First method. Second method, we use the clean surplus relationship. We use the retained earnings, right? The retained earnings, where I'm just going to flip back to the retained earnings here. So these are the retained earnings. So we are looking at 2006. So this is the one that is the ending retained earnings, beginning retained earnings. Beginning is this 8,000. Ending is this. We are given the profit here, right? So we can pass out the dividends that's given, which is we find that the dividends distributed is this. So dividends distributed divided by the number of shares will give you the dividends per share. Any questions for this? Yeah, good. Okay, this is a bit easier. Now, we do the FCFF now. So if you can't recall the formula, flip back to the previous slides that we talked about the FCFF formula. So it's the OCF minus NCS minus this. Okay, so let's calculate each component now, right? So operating cash flow. We use the basic formula, which is the EBIT formula, minus the 1 times 1 minus tax plus depreciation. So let me just flip back to show you the EBIT. So we are given here EBIT, right? That's why I want to use EBIT. It's already given here. So 8,000. What's the depreciation? So depreciation, can you hit, is here, 2. So we use the EBIT multiply by 1 minus tax, because tax rate was given at 20%. So we calculate what is the operating cash flow. Now we calculate what is the NCS. And this is where just now I highlight to you that, hey, you know what? Be careful what they give you. Is it a net or is it the gross? Okay. So in this case, what is given here? In this question, let's flip back. Gross. Can you see? So okay, there's the net and the gross lah. So we can simply take the gross here, which is given at this, right? So if we take the gross, we do not need to consider depreciation rate. Yeah. So we simply take the gross. So we did not add the depreciation because we are using gross now. Okay. So we can find your NCS. Now, in terms of net change in working capital, right? Working capital is CA minus CL, right? But change is the change, right? Is the year 1 minus year 2. Oh, sorry, year 2 minus year 1. So, and remember, we are looking at CA and CL. So, what are the CA and CL that we have to consider here? Okay, CA, let's look at CA first. Let's look at, we have considered inventory, receivables, other current assets, right? So these 3 components here. So we need to take the change, right? So we take 4,000 minus 3.5, 4.5 minus this minus this. What the CL that we have to consider? Let's see. Other current liabilities. We'll consider this. Accounts payable, right? We have to consider these 2. Okay. Any questions here regarding picking the items? Because when you do your valuation, right, when you look at the financial report, sometimes there's so many items. So you really need to pick the correct items. And sometimes if you're not too sure, maybe just write a short statement on why you choose the item. So at least if it's wrong, we can still give you some method marks, or okay, maybe that argument makes sense. We try to give you some method marks, right? In selecting the items to pick for this change in net working capital. Okay, any questions? We are good. So remember, once we do the change, we need to take the CA minus the CL. So I'm just flipping back to the slide. So these are all the CA, and this is the CL. Now, for the FCFF, we fall back into this formula. So we just take the number, 8.4 minus 5 minus 0.5. We get 2.9 here. Any questions so far? No? Okay, we are good. We are good. Okay. So I want to highlight to you in the difficulty in the FCFF and valuation in general, right, is really picking the items, and the point that I think we have mentioned a few times in this lecture is that selecting the item and justifying how you get like the discount rate and this kind of things, right? Because at the end of the day, anyone can come up with any valuation if you just randomly pick stuff, right? If you say, I want to pick this, and then you just value a company. Yeah, so anyone can actually value, but really justifying why you pick the items is more important especially in this course when you do your your assessment, your GPA, even your finals. Yeah, really justifying why you pick those items. Okay, so FCFE, right? So let's look at FCFE now. Basically, I'm going to use the basic form of the formula, and I'm going to add the net borrowings here. So what's net borrowings? Remember, net borrowings is basically just a change in amount borrowings, right? And let's look at what are the borrowings we have in terms of short-term and long-term. So let's look here. Short-term debt. What happens to the short-term debt? The short-term debt has been decreasing, right? Meaning that it has decreased. So, okay, fine. That means we have repaid the debt. What is happening to our long-term debt? Long-term debt, it has been increasing. So we are taking on more debt. So more cash flows. We have more cash flows. So what is happening? So we need to find the difference in the debt between the 2 years. And then for the long-term debt, it's a positive, right? Because there's more cash coming in because the debt has increased. So mean more cash in the company. But the short-term debt, it has been decreasing, meaning what? That we actually have to pay off. So at the end, the net borrowing is 1.82. Okay. We know all these figures already, right? From the balance sheet. So we just take this plus 1.82. And then the question is asked, you fix FCFE per share. So make sure you divide by 1. So this is important. This part, I mean, usually it's just like 2 marks or 3 marks. But a lot of times, you can't forget to do this. So you calculate FCFE and then yay, you're happy and you're done. But please remember, if the question say per share, please divide by this. This is like 3 marks. Usually this is like 3 marks or 2 marks. So don't lose that one few marks. Okay. So I hope you can see now how the formulas come into play. Yeah, the various formulas, and how they work in an simplified example given the limited information of the financial statement. Now, RI, we use RI now. So RI, we use net income minus equity charge. But remember, our equity charge is T minus 1 because for explanation earlier, meaning that we're using book value at T minus 1. Okay, so let's just look at the balance sheet again. So what is the book value at T minus 1? Remember, I said it's retained earnings plus paid up capital. So it's these 2 components here. So it's 18,000 because, and we are using 1 year, we are using this figure. Okay, so it's 18,000. Cost of capital, cost of equity was given to you, so that's fine. And then we can calculate the residual income here. So let's compare our residual income amount with the FCFE and FCFF. So it's kind of similar, but actually it's quite different for FCFE and residual income. Can you see? Because we have considered the implicit costs, right? So that's why the so-called income is less, right? And remember, at this point of time, we have not done the valuation, the sense of we have not discounted by the for residual income, we have not put book value plus the present value of residual income, right? And then for FCFE and FCFF, we have not discounted by the relevant discount rate, right? To do the valuation. So this is not a full valuation question, but it basically just show you how you calculate FCFE per share, residual income. But you can see the residual income amount is less because you include the implicit costs that we have to, to consider. Okay. That's just a quick, simple example. Any questions here before we jump into the lecture example, which I talked about that if we have time, we go through, and now we have time, so it's perfect. But before we jump to that, that's all actually for this lecture. Any questions regarding what we have covered so far? Also, since everyone is here already, I also like to highlight any issues regarding your GBA, please email me quickly. Please reach out to your group members as well, so to make sure they are in a course, they are okay with your grouping, especially those that did not choose your grouping regarding GBA. So please start early rather than too late, because if you find out like 2 weeks later that your group mate is no longer in the course, then you'll be a lot of issues. Yes, so it's a summation of the present value. Remember, summation of present value. Because remember, we are always in the time value of money space, because we are in finance. So SCFE, can you see? Summation of the present value. So we need to consider the discount rate. We need to discount everything back to the present. Yeah, but remember the T here. So remember your timeline. So 0, 1, 2, 3. So if your cash flow is here, you discount by 1, your cash flow, yes. Yeah, so remember, we are always in the time value of money space. We always need to consider discounting on the right. Yes, according to, yeah, perfect. Yeah, that's a great question. Thanks for bringing that up. So I hope everyone knows this. Yeah. So any questions so far? Regarding the DDM, FCFE, FCFF, again, the next lecture 3, we're covering DDM, but we're covering really the details of doing multiple variations and all the fancy stuff, right? So you will need to have a strong understanding on all these components now. All right, so if you do have any questions, feel free to ask them along the way. But I want to quickly just go through this lecture example. So I want to put it up front that, first of all, this lecture example is not like a past exam. It's not anything, right? It's not a past GPA, whatever. So it's basically my example that I created simply for just understanding components of valuation, which I believe is very important, and it gets very confusing. So at this point, I'll go through the questions step by step, and it will be good, if you can just like see what are the issues here, and you can just type in the group chat or even unmute yourself to say what are the issues that you see here. Okay, so now let's look at this question. So you are a equity analyst. Okay, as part of the summer internship program rolled out by your firm, you are tasked to guide your fellow intern and determine the cost of capital for Nike. So this is not valuation, so this is purely cost of capital, which is WACC, right? Cost of capital. Andy, he's very excited. He immediately get the data. He thought it's useful for analysis. He explains his assumption approach. So it's very good. This Andy explained a lot of things, but remember, Andy is just an intern. So he might not be using the correct numbers. Okay. Now let's quickly look at the question first. Before we discuss the question, the information for each of the part 1 to 4, critically appraise Andy's method. Do you agree with this approach? Are there alternatives? Provide any accompanying assumptions, details. So, they want you to provide a lot of information outside of the question, which is very typical for our course, right? We are no longer looking at information purely from the question. We need to bring in information from Bloomberg, from that set. Okay, so the question is quite nice. They provide you balance sheet, P&L. Okay, fine. That's not so important. It's important, but it's just fine. It's provided by certain things to take note, security, SEC. Okay, so treasury yield here. Okay, interesting. They provide various treasury yields. Just now, a friend of yours asked a question, very good question, right? How many years should you use? 5 years, 10 years, 30 years? Should we use 30 years? Right? And remember, I explained to you, depending on your investment horizon, right? Okay, so now you have that at the back of mind. You kind of, okay, you depend on what's your investment horizon, then you pick the correct rate. Okay, let's look at number 1. We go point by point and we discuss about it. Okay, methodology to calculate cost of capital. since Nike is founded, so this is what Andy is writing. So it might be wrong, it might be right, so we need to appraise this. Since Nike is funded with both debt and equity, I use the WACC method. Based on the latest consolidated balance sheet, the debt and equity makes up 24% and 58% of the total balance sheet respectively. Okay, he even did a calculation for you. Oh, very good. Okay, hopefully you don't look at the answers. Now it's the part where you can participate. So can you say what's wrong, what's right about this that he has done? Feel free, it's a discussion. So what's wrong, what's right here? Try not to look at answers at the back, but yeah. So this really tests understanding about what we've discussed earlier. So Andy, based on the latest consolidated balance sheet, the debt and equity make up 42 and 58% of the total balance sheet respectively. So he wants to use this as the weight for the WACC. So what's wrong or what's right here?
Hi, this is Yokwana. I would like to try.
Yeah.
I think for the liabilities like operation liability, lease liability, and like tax and others, income tax and others liability. Well, this is more like operation costs, and I mean for to be paid in future. It's not a debt.
Yes, that's true.
So I don't think this field should be included in the total debt.
Yes, that's a very good point. Yes. So long-term debt is okay, right? But the operation, lease liability, and the deferred income tax.
Yeah.
You are right.
Liabilities, but it's not a debt.
Yes, you are right. That's correct. Okay, any more? That's very good. Okay, that's a very good point also. You shouldn't even use the balance sheet. Very good. We must use market value of debt and equity. Okay. So those 2 points are correct. Those are correct parts. Okay, let's move on. Cost of debt. So what happened? To estimate the cost of debt, I use the total average interest expense. Okay. Use the total average interest expense for 3 years and divide by the Nike average long-term balance for 2 years. This rate is close to the average of 12 months and 2 years treasury yield, which is in line with my forecast horizon. So his forecast horizon is 2 years. Given the debt, given debt is tax deductible, I adjust the debt by the US statutory rate of flat 21% under this new act. Cost of debt come up to be this. So he provided you with how he calculated the cost of debt. Right, this is before the tax adjustment. So what is the issue here now? Any comments? Is it the correct method? Remember, some things can be correct. Andy, he's an intern. He did his bachelor's in finance, so he's not everything wrong. Can be correct as well. Anyone like give a try? Okay, I see 2 points here. 21 might not be a correct tax rate. That's right. Usually tax, we need to use the what's the term? The incremental tax rate, right? What is the tax rate in the next bracket of income? Okay, That's right, incremental, meaning that what? If you earn some more money, what's your next tax bracket that you are in? Correct? Tax rate might not be correct. We should use the yield to maturity. Yeah, that's right. Remember, we talk about the three methods for cost of debt. We need to use yield to maturity as one. That is the method one, right? Method one, correct? So what's wrong with this method? He used the interest expense, average interest expense divided by average long-term debt. Doesn't that make sense? Okay, yeah, due to maturity. Okay, so you want to use due maturity. That is more or less correct. But what's wrong with his method? Doesn't his method make sense? I take what's the interest expense, divide by my long-term debt. Then I get the interest law, I mean the cost of debt. And then I can, it's quite easy, right? But why is this wrong? Okay, yeah, you are right. It's wrong. Yes. But why? Why can't I use average? So maybe there's this part that I think once I say you can kind of recall. Remember, for debt, right? Debt can be also amortizing, right? Your debt amount is decreasing over time. So it means your interest expense also changes over time, right? That's one point. But secondly, your debt, like bonds, changes with the market conditions, right? Your interest rate environment. Remember, we talked about this in lecture one. Your interest rate is inversely proportional to bond price. So if you just do it average like this is like especially for bonds, is totally wrong, right? We cannot calculate interest like this because bonds, we have your coupon payment, and then you have things like that. You need to calculate you to maturity, so that's wrong already. Wrong to average it across time. That's correct. But if it's a straight loan, so it's a loan, even for a loan, usually interest is not calculated like this, right? Because it's amortizing loan. So this is not too correct. Yeah. So let's look at this. Rate is close to the average 12 months and 2 years. What does this mean? 12 months. Let's look at what's the 12 months rate. 12 months here. Is there an issue with this? Rate is close to the average 12-month and 2 year. Is there any issue with this statement here? Anyone want to give a try? Any issue with this statement? The rate is quite close. Isn't it good to be close to your US Treasury yield? I mean, you justify that maybe your calculated figure of 1.42 is correct. Anyone like give a try? It's, uh, can you critique about something about this? So remember, all these small details is what you really need to consider in your valuation assignment, because this is where the information is like so much information. So you really need to choose what you pick. And that's where it becomes important. So it's calculated based on average of 3 periods. Okay, I see some attempts. Okay, so if for 2 years there is a coupon rate where none for 12. Okay. 12 also can have coupon rate because coupon can be semi-annual. 1.2 is calculated based on average of 3 million. Okay, I see some, but US is for the 3 times. Yeah, I mean, first of all, computing the rate based on balance sheet figure and then compare it with the yield, first of all, doesn't make sense at all, right? Because you're using the balance sheet expense amount and compare it with this. It doesn't make sense, right? That is a very good point. Yeah, great. Nike cost of debt shouldn't be lower than the risk-free rate. Yes, that's right. You're comparing the wrong thing. How can you compare cost of debt with treasury yield? Cost of debt is cost of debt, right? The debt that Nike takes is not equals to the treasury yield, right? Treasury yield is risk-free. Yeah, that's a very good point. Yeah. So it's important. Yeah. Government is risk-free, it should be lower. Yeah. Correct. Yeah. That's the point I want to bring. So there's no relationship whatsoever to compare with treasury yield. That's good. That's a good point. Yeah, you can't less. So what? So if the bond that Nike give is lower than the treasury yield, then everyone will buy Nike already, right? Higher returns, lower risk, which make no sense. That's a great point to mention. Yeah, very good. So this is kind of like also a check when you do your valuation, especially when you do you calculate the cost of debt, cost of equity, right? Do like we call it like a reasonable check. So how reasonable is your answer? Right, that you have calculated. So this is very important, for your finals or GBA, do a reasonable check. Does it make sense? Like, of course, you have data on the risk-free and stuff. Does it make sense that, hey, my calculated figure is so much lower? If it doesn't, then that means you're somewhere off. Okay, very good. Moving on, let's look at cost of equity now. So Andy continues, based on my understanding of the two methods to estimate the cost of equity, I'm inclined to use the CAPM model instead of the DDMR. So he said he's inclined, given the superiority of CAPM method. He didn't explain why, but he said it's better. I understand that a company plans to hold the stock for 10 years. Oh, so now he knows that the company that he's working for wants to hold the stock for 10 years. He continues, I have used a 30 years treasury bond yield as my risk-free rate, the arithmetic mean of the historical equity risk premium of this as my risk premium. And for the beta, I took the average of Nike beta for 30 years from now, average beta of 0.8. Based on this assumption, my cost of equity is this. Wow, there's quite a lot of information here, but what's wrong with this now? Let's try to discuss. Anyone like give a try? What's wrong with this? Let's start off with we can start off anything. What's wrong with the cost of equity now? Anyone like give this a try? What's wrong with the cost of equity? You can speak, unmute yourself, feel free if it's easier rather than typing out. And in volunteers, what's wrong with, or what's right as well as what's wrong with the cost of equity?
This is your corner again. I'd like to try. I think using CAPM method is correct because there's nothing mentioned about the dividends payment.
Okay.
So yeah, you got to use this so-called no choice.
Okay.
Yeah. And then since Nike is holding the stock for 10 years, and why is it using 30 years bond yield?
Okay.
Yeah, I think you should use 10 years instead of 30 years.
Yes, that's correct. Yeah. Match horizon. Very good. Very good. Yeah.
Then he took the beta from 30 years ago also. I mean, I think you should use like 10 years or so instead of 30 years. Yeah.
Yeah, correct.
Okay.
Very good. Thank you. Yeah, very good. So I see someone also mentioned about the 30 year, 10 years. Okay. I guess you all caught that. Using bond yield as risk-free and equity and risk premium, that one is fine. There's no issue with that. Because your bond yield is just for the risk-free, right? So it should be okay. I see a comment also. He shouldn't use 30 years treasury because, okay, yeah, 30 years. Beta should be past 5 years. Okay. Sometimes you use 5 years to remove the noise and the bias. That's true. Yeah. Okay. So risk premium can be more specific to industry. Yeah, we can use industry risk premium if that's something you can find online. That's true. Oh, okay, that's good. Yeah, football field. I think some of y'all wrote as in red lecture one example. Yes, the football field is a good comparison method. We can use that. Yes. Okay, that's a very good point. Average beta is can be wrong, right? Maybe you should use average beta. What you should use is the regression, right? So if you can really run the regression to calculate what is the actual beta, that might be even better to use the regression method. Yes, correct. So this is not really covered in our lecture, but I like to bring this out as well that yes, you should use geometric mean instead of arithmetic mean because arithmetic mean is biased in the long horizon. Yeah. So this is not something that we have talked about, but yes, that's why this example was put there. That's correct. Okay, so thanks for the reply. Let's just look at the last part. So so now after everything WACC time, based on my WACC calculation, my estimated cost of capital for Nike is 4.64. I noticed that my WACC is quite different from the WACC in FedSet. I do not know why. Okay. I guess having answered the few parts, we already know why. Because he made a lot of mistakes. All right. So remember, part of this question is first of all to critique, but at the same time, you also need to be able to suggest the right way to calculate. So in the model answer here, not really model answer, but like suggested solutions, I did bring in some calculations. So these are what I did in terms of the calculations. I show you where to get the value on FactSet. I did the calculation Excel. Basically, in FactSet, you can export the files. Okay, I did a calculation Excel. I show you how to get all the weights. All right. Cost of equity. I show you how to calculate this. And even compare it with the figures provided at FactSet to verify their figures. Because remember, whenever you pick numbers from Bloomberg, FactSet, Capital IQ, Infinity, whatever, right? You should know how they calculate it. So you can actually use that. You can cite the sources, but you need to know what assumptions, what things they use, because sometimes they can use a lot of adjustments and this and that, and then maybe you don't believe the adjustment is correct, right? So as a equity analyst, you need to be able to support your answers that, hey, yes, you know what? Yes, I use these figures, but these assumptions are correct, and therefore you justify, right? So doing a check on their figures is quite important as well, right? It's um, part of your valuation process. So let's say you write your valuation report. You just say, I pick this number here and there from Bloomberg, and you say, oh, okay, I get a valuation. There is, as an equity analyst, you have no value add if you just pick numbers here and there, right? But to verify whether the numbers are correct, that's where you bring value into your valuation report. Any questions on this point? Because this is important. So you can pick numbers, but you need to really justify. Okay, So what else? So I provided some answers regarding the statutory tax rate. We should use marginal tax rate instead. Marginal meaning what is incremental tax rate if we have more revenues, right? Sorry. But at the same time, you know, as there's insufficient information on marginal, we can use effective as well, which is better. And this is from the notes to the financial statement. Okay. Well, cost of equity. Okay, so someone say CAPM is pretty good because there's no dividend. Fine, that's good. DDM has a strong bias to a growth factor. Okay. So most people picked up about the different year. Fine, it's good. Regarding equity risk premium, do not use arithmetic, you use geometric. Okay. So this is some explanation. So you can have a look at it. This is something that we talked about earlier about the premium, the equity risk premium. That I strongly encourage you to look at this link here. I strongly encourage you to look at this. So if someone talk about the beta that is noisy, that's correct. Okay. So even in that set, there's a lot of beta, raw beta, adjusted beta, levered beta. So which beta you use? So you still have to give some justification. Remember I said when you pick numbers, you still have to justify which beta to use. Okay, and you calculate, and you actually recalculate the CAPM. Now calculate WACC, you recalculate it based on whatever adjustment you have made. Okay. So these are some just explanation on what adjustment that you have made. So last part, right? This is the beta, right? So can you see this is the calculation used in FedSet. So you can see actually the beta. Where's the beta? The beta here using the 3 years beta. So given that the question may tell you your horizon is 10 years, maybe the 3 years beta is not correct. So that's why in this part here, we noted that if we substitute our beta, which is calculated this, with this, the resultant WACC is even closer to FedSet one. So there's some like justification that comes into play here, like why we use this, why do we not use this, etc. So yeah. So maybe that's all for the lecture today. Any questions regarding this example? I surely encourage you to review this example again in detail as well as the answers. Okay, I'll pause the recording.